What is up, everybody? Welcome back to another amazing episode of FedWatch. My name is Ansel, lindner, and I am back this week with my co-host, CK. CK, how are you doing, man?
Doing good, Ansel. Good to be back. Sorry I missed you last week, but glad that the Bitcoin Magazine co-hosts could jump in and fill in for me. Excited for today. We have a ton to talk about. Ansel, back to you.
Yeah, so today we're going to go over a bunch of charts. I really like going over charts on these live streams because people can follow us and watch us and look at exactly what we're saying. And for the audio listeners, you can always find these charts in the link to the slides in the write-up, wherever the description that you're listening to this podcast. So yeah, we're going to go over chart updates on Bitcoin, some currencies, some treasury yields, some energy markets, and then get into some crazy stuff that's happening geopolitically with developments in the sanctions against Russia and this Taiwan stuff with geriatric Polosi going over there trying to start World War III over there in Taiwan. So we'll see how
How do you really
that
feel?
goes. Well, I mean, I really don't think there was any threat, but most people are talking about it like, hey, she's a crazy old lady and she's going over there to start World War III. So we're going to dive into it and talk about it.
Before we get into it, I just want to give an in-person shill to the censorship resistant Bitcoin Magazine. I'm showing off the outside. Look how thick this thing is. It's really incredible. It is a piece of Bitcoin art, definitely a collector's item in the future. So, I got to show it off. There's just amazingness throughout this thing. Bitcoiners, you got to get a hold of this, get the subscription. We have a fresh issue coming up. It's hitting the press in the next couple of weeks, and it is going to be launching next quarter. So that's going to be the Q4 issue. So not going to drop too many details, but I'm getting a note from Chris that I also have to show the cold storage issue. So if you get the cold storage subscription, you get an issue that you can open up and read, and an issue that's plastic wrap that's perfect for framing, perfect for cold storage and saving it for collectors. So check that out. All right, that's it with my shill, Ansel. Let's get into some of this. I know you got some pretty cool charts that you want to jump into.
Yeah, but before we do that, real quick, I just want to shill my new YouTube channel. It's FedWatch Clips. So I'm taking clips out of this show and putting them up there on their own channel. You can just search for FedWatch Clips in YouTube and find it. I only did one last week, but I'm going to try to get more time and do 2 or 3 from each episode. Also, my Telegram channel is popping over there. I'm doing live streams every day over on Telegram. I wanted to do 15-minute live streams. They last like 2 or 3 days. They've been 30-minute live streams. People are loving it, talking about similar stuff that we do here on FedWatch, but tying in Bitcoin even more, some economic analysis into Bitcoin itself. So check out the Telegram. It's t.me/Bitcoin and markets.
All right. That's it with the shills.
Okay.
Let's get into the content.
Okay. So Chris, we're going to the slides, my man. Let's go to slide number 2, please. First up is the Bitcoin chart. And this has been kind of my bread and butter here lately. If you subscribe to the free weekly newsletter at bitcoinandmarkets.com, I'm posting this weekly chart all the time. As you can see there on the right-hand side is like the volume at each price level. This is called volume by price for indicator. I think the price has bottomed, and I did expect it to kind of rise into that gap in volume in the mid-20s. That hasn't happened, but that could happen over the next few days and into the end of the week. I think that's more likely than breaking the $20,000 floor once again. So, Christian, any comments on the Bitcoin chart?
When I look at we have the Bitcoin chart up at the Bitcoin Magazine office on the big screen all the time. And when I'm looking at it right now, I'm just seeing higher lows and higher highs off of, that point that you're indicating to be what you consider to be the bottom. So, it's pretty early to tell. I'm very interested to see what your analysis on the most recent FOMC was and some of the talk around central banks and macro, because obviously that is having a pretty big impact right now. But it appears to be, like I said, higher lows, higher highs. So we'll see what happens. I'm definitely not a macro analyst, I think right now, Bitcoiners, if whatever your whatever your DCA is, if you can afford it, double it. So this is a good time to keep stacking. It's not about try to time the bottom. This is very, very low in terms of 200-day moving average, etc. So yeah, double your DCA.
Absolutely. Yeah, we talked about the higher highs and higher lows last week. And so, yeah, after the FOMC meeting, the stocks and Bitcoin both rallied after that. So that's interesting. I might have to do a separate episode and just talk about the reaction to the FOMC meeting. But I do expect the price to kind of go into that gap in volume and maybe consolidate for a couple months. Or a couple weeks, and then try to go into the 30,000s.
I was going to say months. Jeez.
Yeah, sorry, a couple weeks, and then that would also go along with a lot of my timing on the geopolitical stuff, like the European sanctions and China and all that. So, yeah, let's continue with these charts. So let's go to the next one, please. This is the dollar chart, and we've shown this several times. This kind of exponential curve that it was following, and it has broken out of that. Now, I'm not saying this is the end all be all technical analysis. This is a super simple exponential
this
curve.
Line is God, Ansel.
it has broken through, and I'm just trying to show that the momentum is slowing. The trend of the strong dollar is slowing, and of course, this is against other fiat currencies, mainly the euro and the yen. So we'll talk about the yen here in a second. Next slide. If you zoom out, then you can have the monthly chart on the dollar. And this is, you can see the shaded areas. These are the different steps, kind of a stepwise function since the great financial crisis. It started in the low, 70s and 80s. Then it got up to the 90s and up to 100. And now I think we're just going into a new higher range. A lot of people are expecting the dollar to fall, but that's not how the credit-based money works. All right, where the dollar is going to be permanently higher. It just depends what that range is, whether it's between 100 and 110 or 100 and 120, something like that. That's where the higher range is going to be. Any comments on the dollar before I move into talking about other currencies?
I think that we do a lot of education here about like what's the underlying dynamics of a credit-based money. So it's really interesting to see the cognitive dissonance between those screaming hyperinflation and then strong dollar simultaneously. It's been very interesting to see that kind of playing out. And yeah, I would like to give another shout out to Ansel. I think Ansel has been, relatively directly correct about like, what is fundamentally happening here, even through a lot of kind of noise and even name calling from those screaming inflation just 6 months ago. So obviously CPI is up. I think there's a lot of reasons why that could happen. But at the same time, the dollar compared to other fiats, you can see this trend, since 2008. It's been kind of reaching for those next levels, and we'll see if we get that to that kind of early 2000s level for the dollar before it came crashing down.
Yeah, and strong dollar signals that there's stress in the financial system. So if we go to the next one, is a Hong Kong dollar. The next chart there, you can see back. I took a few years time frame here, and going back to 2018 and 19, it was testing the top of this range that they peg the Hong Kong dollar at. They peg it between 7.75 and 7.85. And we've talked on this show several times that the economy was already rolling over before COVID ever hit, right? Before 2009, you had the 2019, you had the repo rumble. You had the Fed pausing and cutting rates in 2019. So you can see that the Hong Kong dollar was really reacting to the stress in the financial system, pressing up on the top of that peg. And we're back up there again. Now, Hong Kong does have a lot of dollar reserves, so I don't think this is in danger of breaking anytime soon. But I do think that it does signal that China is having a major kind of dollar shortage, a major credit problem going on, and we've covered that on the show here, and we'll cover a few other things today. If you go to the next slide, is Japanese yen. And we've heard a lot in the last couple months about the rising or the falling Japanese yen. On this chart, it's rising, more yen per dollar on this chart as it goes up. Something I just noticed, though, as I was preparing for the show was, they had a very big, important election that just happened. And I wonder if you guys, Christian, if you can guess where on this chart did those elections take place?
I'm assuming it happened when things started going, when the dollar started to lose value against the yen.
Yes,
Is that correct?
it happened at the top, at the very tippy top, almost to the day. The Japanese yen stopped, going down against the dollar and has since rallied 6%. And that was also, remember that Abe got assassinated just a couple days before the election. And he has this conservative, was a leader in the Conservative Party who has a majority in the parliament there. And this very important election was coming up. And it's crazy how you look at this chart and somebody knew that there was stress in the system. Somebody knew that they were trying to take out the conservatives over there because, Abe was a big proponent of rearming Japan and getting their navy back and all that. But the result of that election was the conservatives actually increased their share in the parliament slightly. So I don't know. Maybe that's why we were seeing some decrease in stress going on over in Japan. I just thought it was fascinating that the election marked the very top of this chart. Any
The
comments
top
on
of the
that?
dollar in terms of the dollar to Japanese exchange ratio. So,
Yeah.
very interesting, for sure. It really is interesting to see how these charts react to global events. And, I'd even be interested in you've done this before, but you've done highlights and you've done pointers of global events. I think you did that with hash rate as well as Bitcoin price, around the China exodus. A lot of that kind of analysis is very, very interesting to see. So very good observation there. And yeah, I think that there's other signals kind of like this everywhere. So you just gotta, be able to find them.
Yeah. And there is, the main rival of Japan is China. And there's all this military talk now with Taiwan. And so I just think that there's stuff going on that we don't see in the headlines and that you can see in the charts. Once you can see it in hindsight, like, oh, look, this is what happened when this political event happened. And so somebody must have been on that side of the trade, or you know what I mean? And I just think it's fascinating. So next couple charts I have here is on the yield curve. So Chris, could you go to number 8? Yeah, so I've been posting this on Twitter almost every day, maybe every other day as an update. And what you see on this colorful chart, that's just the yields on all of these different tenors of U.S. Treasuries. So up to the 10-year, you have 4-week, 3-month, 6-month, 2-year, 5-year, and 10-year. And it's just interesting that as the Fed has been raising this Fed funds target, the higher end or the longer end of the yield curve doesn't care. It's still crashing. And even after they did the 75 basis point rise, just last week or whenever it was, the rates have crashed since then. So it's amazing. A lot of people are watching the 3-month and 10-year. That's the next one to cross. And if you go to the next slide there, Chris, that's the 10-year 3-month. And look at that curve. I mean, I pointed out some periods back in 2019 when Powell pivoted last. He pivoted at around 35 bips. And then he started cutting rates when this went inverted. But just look at what's happened over the last couple months. It's gone straight down. And the market is expecting some crazy event to happen, whether that's this week, next month. What I do expect is usually markets tend to be very volatile around the end of Q3. I think I mentioned this last week as well, but you have, Lehman Brothers, you have 9/11, you have the 92 Soros attack on the British pound was in October. Then you have 1987, the big market crash. You have 1929 and the Great Depression crashed in October. And then you have even the panic of 1907 happened at the end of third quarter. So it seems like the end of third quarter is when all of these big market crashes happen. And this chart is signaling that there is major stress in the system. So all eyes from me are going to be on about September 15th to October 15th. That's when I'm expecting some major fireworks.
Very interesting. Okay. And just so you can be really specific, looking at this chart, effectively what you're trying to show is that the market is doing its thing. The Fed is,
Yes.
making a proclamation. The market is effectively doing the opposite. Really, it's kind of doing its own thing. It doesn't really seem like it's necessarily reacting to the Fed directly. Is that what you're trying to indicate here?
Yeah. Remember the Fed Powell pivoted around the middle of last year, at least in his rhetoric. It didn't really start until December, but this chart didn't peak until May. And it's just fallen off a cliff since then. So there's really no correlation in my mind on this between the Fed and what the market is telling us. If you go back to slide number 8, please, Chris, then you can see a lot of people were asking me like, why does the inversion matter? What is the inversion telling us? Why does it matter if the 10-year is crossing under the 3-month? Well, these two things have different utilities. They have different functions in the financial system. So usually Treasury bills, 1 year or less, they are used as collateral in repo. So that would be for like business operations. And then the 10-year and 30-year, those are usually used as hedging devices. So for against uncertainty in the future. So if the 10-year is more popular, that means that the rates are going down because more people are buying the 10-year versus the 3-month, right? Relatively. And that inverts, that means the biggest, most sophisticated market in the world is hedging more than they're doing their normal operations. And to me, that is a pretty significant thing. They're expecting something to happen in the very near future, and the hedging pressure continues to grow. And then once you get inverted, that means the probability of something happening, because everybody's hedged. So everybody can see more and more that there's a crisis coming in the near future. And as those things go inverted, it takes a lot of money and a lot of pressure to push these things inverted. Once they do go inverted, the probability of something happening is very high. So that's what the yield curve is telling us.
All right. So prepare yourselves. Ansel's targeting end of Q3, beginning of Q4. Historically, it seems like pressure builds. There's a cyclicality to the world, and it really is amazing seeing these long dated bonds going under the short dated bonds. So obviously that's saying something. So and it I would say, like, at the very core, it's indicating that the system is not working. There's something wrong here. But I'm sure there's more specific things. But I don't have much to add. I don't know if you have another chart here, if we want to go to the next subject.
Let's go on to the energy charts real quick. We got plenty of time. We got a whole hour for this, Christian.
Chart ain't no rush.
Chart heaven. All right. So
I'm just dumb.
Oh, come on now. This is a chart of WTI oil. This is US oil. And I just drew a few lines on this chart. And I know a lot of people in Bitcoin don't like technical analysis, but I think it's amazing to look at this chart. You see where back in March of this year, it broke out. And right at that level that it broke out, it's been testing several times. And right now it looks as if it might break down out of this support. And where's the bottom for oil? I think this is a very important chart in the world, because where oil goes, CPI usually goes. A lot of people were calling for higher oil prices, but as we can see, it keeps dipping under $100 a barrel. And my expectation is that it continues lower. We're going into recession, and in recession, demand goes down. So as especially in China. I mean, they're in a financial crisis. So the demand in China is going to fall through the floor. So demand around the world is going down for oil. At the same time, month over month, we're getting increases in the supply of oil. A lot of people were scared that the Russian supply would come off the market. They've been pretty stable. Libya actually just came back onto the market with about 1 to 1.5 million barrels a day. The U.S. keeps adding slightly. Right now, the U.S. is pumping about 12.1 million barrels a day. The record is 13.1. So we're pretty close to the record oil production in the U.S. And that's with all the stranglehold of the administration, on the oil companies and things. So yeah, I expect recession to push demand lower, and supply is going to remain relatively constant. So I think the whole narrative of really high oil pushing a reinforcing inflation cycle is way overplayed. If you go to the next chart, yeah, go.
Well, before we go, what
Yeah.
does this mean for Europe? Because simultaneously, Europe is facing a crisis in actually getting energy, both because of their actions domestically and within the EU, as well as because of altercations with Russia and that supply chain, and even also issues in the U.S. I know a really big I think it was a liquefied natural gas facility in Texas blew up. And
Yeah.
that at least took several months of production offline. That was really earmarked just for Europe. So, what does all of that, kind of like stress in the European energy markets, and then simultaneously energy prices and oil prices going down? Like, what does that mean?
Well, I mean, Europe is in a completely different situation. When I look at the world, I see there's kind of three major powers or areas of concern. You have Europe, and that includes Russia, China, and that includes like Japan, and then the US. So in the US, I see the recession pushing oil prices down, CPI coming down, relatively stable over here. But in those other two areas of Europe and China, they're having their own problems. So when you sanction a country that you get most of your energy from, and prices go up, this is not money printing. I don't know why people think that inflation, the quote unquote inflation that they see over there in Europe, is due to some sort of monetary policy, and that the ECB or what the Fed does or what anybody is doing in central bank land can affect the price increases that are happening in Europe. It is completely outside of the realm of monetary matters, and it is completely in the political realm. Those politicians are kneecapping their economy. That's what we see in Europe. We don't see the same thing from the US. We see a little bit where the Biden is, really coming down hard on some of the oil companies and things like that. But for the most part, we don't see the kneecapping of the economy like we do over there in Europe. So they are in a completely different situation. And we'll get to a chart here in a second of the European gas prices. But yeah, I agree. They're in deep, deep trouble over there. Did that answer the question?
I mean, I think what you're saying is that like it doesn't really matter what oil is doing because their issues are political.
Yeah, and you're sanctioning your supply. So that's what's going on in the global oil market is not going to be represented what's going on in Germany or in the Netherlands, because they're sanctioning their supply. Their price structure is completely dependent on their political actions that they're doing. It has nothing to do with the supply and demand of oil. But okay, let's go on to the next one. This is a monthly chart of U.S. oil, and I just want to point out that we peaked in the Great Financial Crisis, and we did not get back to that peak this time, and also we hit zero. And the monetary problems that can happen when you hit zero, you have demand destruction, or you don't have demand destruction, you have supply destruction going on. People going out of business, oil producers going out of business, and then of course we're going to have a reflexive spike in oil prices. But I do think that it's coming back down, and it will act similar to the way it acted in the Great Financial Crisis. We'll have a fluctuation in a middle range. Where that is, I don't know, but I don't expect a blow off top in oil. That's already happened. We're just going to consolidate here. Next slide, please.
If I could just jump in,
Yeah,
this
absolutely.
is anecdotal, but driving around Nashville, you can see prices are going down. Even I was just recently in California, and prices are down substantially since I made my cross country drive. So that top right there, I was buying that at gas stations across the country driving, but
Yeah.
they have gone down significantly. So you're seeing this in like the just the regular market.
Yeah, absolutely. And it has nothing to do with administration policy, right? Like Biden, now they're trying to pin quote unquote inflation on Biden, and they're trying to, Biden's trying to take credit for the price cuts or the price drops. But none of this has anything to do with them. So this is kind of its own beast. But on the next chart, I have gasoline prices. Speaking of gasoline, this is gasoline futures. So not oil, but gas, refined gasoline for, I don't know, E80, 87 octane or 89 octane, whatever you're using. And we did reach an all-time high, but it is coming back down. So we'll see where this goes. I think it could fall down to $2. And man alive, would that get people these inflationists to think, well, maybe inflation isn't going to be a runaway type thing. Maybe we have to question our assumptions.
We're already seeing the shift. We're seeing other
Yeah.
commentators coming out with similar talk tracks, and going beyond like a Jeff Snyder, and actually connecting the issues with the current monetary system to the solution that is Bitcoin, which is what we do here.
Yep. All right. So next two charts I have, we'll run through these real quick. This is the European natural gas futures, and you can see it's just gapping up. It still continues to gap up. It's at $200 per contract here. And then on the next chart, what I think is important is this is the current futures month, 1 year out, July 23 and July 24. If you look at July 23, it's where the front month contract was like 2 months ago. And the 2-year front month or 2-year forward is where the front month was just at the beginning of the year. So it's starting to look like there is no end in sight. There is no relief coming to Europe, that these energy prices are just going to continue to go up. And that brings us into the next story, which is the European sanctions and a development on that front. So do you have any comments on this, or should we roll into the article?
So just really quick, effectively what this is showing is that this month, and then the contracts for purchasing oil for the next 2 years
For delivery in
are
July 23.
extremely elevated. So, pretty much what it's saying is that the market is pricing European energy, even in 2024, that you purchase and lock in today as being much, much higher than, the mean or the average prior to, this crisis. So, very, very bearish, very scary. And like you said, 2 years of elevated energy prices, like how long can Europe sustain this, really? Like, how long can they do that? Yeah, I don't know.
Yeah, and the European narrative right now, if you ask the globalists, they're not stopping. Right? They're going full bore into these sanctions, and they're ready to crash your economy. But maybe they're lying to us. Maybe they're lying to us. That's the next story here. Let me pull up this. If you go to the next slide there, that is the Financial Times article. I'm just going to read through this real quick, and Christian, stop me if I'm droning on or whatever, but there's some really important points in this article. So European governments have eased back on efforts to curb trade in Russian oil, delaying a plan to shut Moscow out of the vital Lloyd's of London maritime insurance market, and allowing some international shipments amid fears of rising crude prices and tighter global energy supplies. The EU announced a worldwide ban on the provision of maritime insurance to vessels carrying Russian oil 2 months ago, expecting coordinated action with the British government. However, the UK is yet to introduce similar restrictions. UK participation is pivotal to the effectiveness of any such ban because London is at the center of the maritime insurance industry. Meanwhile, Brussels in late July amended some curbs on dealing with state-owned Russian companies, citing concerns over global energy security. So they're citing this concern over global energy security. They're over supplies, global energy supplies. They're supposed to really crush Russian exports by refusing to insure the vessels. And we actually saw this early in the conflict in the Black Sea. Some of the exports coming out of like Crimea and out of Odessa and things, the ships weren't going to sail in there because they couldn't get insurance to go into a war zone. And now they were going to apply that through the main player, which is London, apply that to all Russian exports. And that was supposed to be their big kind of chess move that they moved into checkmate. We got you. But that's not really the case. So let's continue reading. A joint UK-EU prohibition on maritime insurance would constitute the most comprehensive restriction to date on Russian oil, ending access to much of the global tanker fleet for Moscow's exports. But U.S. officials have expressed concern that an immediate global ban on maritime insurance would push up prices by pulling millions of barrels of Russian crude and petroleum products off the market. European and British officials told the Financial Times in May that the UK had agreed with the EU to coordinate a ban on insuring Russian oil cargoes. However, Britain's latest sanctions against Russia, approved by Parliament just last month in July, only prohibit providing insurance to vessels carrying Russian oil to the UK, and only after December 31st. The legislation was introduced after the government promised to outlaw the import of Russian oil from the end of the year, but does not ban the provision of services to shipments from Russia to other countries, UK officials said. So, wow, this actually is a big development. Everybody was expecting these sanctions to, get tighter and crank down on the Russian economy and Russian export of oil. But the UK surprised everybody and they said, no, we're just going to not insure those shipments to the UK itself, but to all around the world, India or Argentina or Turkey or wherever these shipments are going, they can still go just fine. We'll insure them. That's a pretty big wake up call. The EU insurance.
It's crazy though, because it just shows how toothless these sanctions are, but also it just shows how willing the UK is to pretty much throw their own people under the bus to virtue signal. Like, hey, they're gonna strip out the effectiveness of the sanctions because they're unwilling to give up that international business opportunity. But they will still expose their people to higher prices that way. They could appear as though they're doing something. It's just absolutely pathetic. It just shows how misaligned the incentives are. Like, these politicians in no way are trying to help their people. Like, what the actual hell is that?
Absolutely. But there is no ban on middlemen buying the oil first. So it goes on later in this article. I won't read it all, but I just want to summarize it here. They're saying the EU also surprised with their most recent sanctions package, saying that companies in Europe can deal with certain companies in Russia as long as they're not shipping or buying oil from them directly. So Europe could buy oil through, say, an Indian company. It's just a shell company set up. It's Russian owned maybe, but it's set up in India. They buy the gas or the oil, and then they sell the contracts to Europe, right? You could even have a thing where ships are leaving from Russia, and then middle of sailing from a northern port past northern Europe, this Indian company actually sells that oil or gas to Europe, and so then it just deviates from its initial course and goes and delivers it to Europe. So it's just adding a little fee on top for the middleman. But to my mind, this is a complete rollback of the sanctions. So it's kind of under the radar now, and it saves face for the EU and for the US and the UK. They can say they put sanctions on, but really what it's doing is it's making the sanctions more lax. Does that make sense?
It does make sense, and effectively what it does is it's really sinister because it's like each country or each nation or each electoral body is pretty much willing to throw the market, throw their people under the bus, and then on the flip side, completely defang the actual mechanism. They're all willing to do that,
Yeah.
So it's like, why why are you misleading people? Like, why are you like what is happening here? So I think it
Saving
is
face.
quite alarming. It's really quite alarming. But yeah, it is saving face, and it just shows the ineffectiveness. Like these politicians and policies, like they'll do whatever it takes to say, look, I did this thing, I fixed it, and I'm the reason prices went down because of our whatever policy. And I mean, it's all just a game. It's really sad.
Absolutely. Well, the Russia called their bluff. Russia knew that they couldn't make it through winter, and so that kind of the one of the themes of this show, these two geopolitical topics I want to talk about, Europe and China. It's two times now these people, their bluffs have been called. So in Europe now, Russia has called the EU's bluff, and over in China, it appears that the US might have called China's bluff. So, any more on this stuff from Europe, or should we move on to China?
No, I'm very interested to talk about China. I'm hearing a lot of interesting takes going around, with China's positioning and what they might do. So I'm very curious to hear about what you see.
Well, yeah, I'd be curious to hear what you're hearing out there as well.
Well, I
I've been talking
mean,
about this all.
yeah, go for it.
Go ahead.
No, you
No,
go
go,
for
go,
it.
go.
I was just gonna say people are noticing that the real estate market there is one huge, two in dire crisis, and
Yep.
contagion is everywhere. And when a country is in a really really bad position, they might do something rash. So we don't know exactly what that might be. Some people are saying go after Taiwan. That we already, like, I don't think people give them enough credit that they've already taken Hong Kong, and for whatever reason, the West didn't do anything about it. And we've seen Hong Kong get completely, Chinafied. But yeah, I mean, it's very interesting to see what happens with Taiwan. On the flip side, you're saying the U.S. is calling their bluff. Nancy Pelosi just landed
Yep.
in Taiwan, so I'm very curious to hear what your analysis is.
All right. Well, yeah, I said that this wasn't going to be a big deal days ago on my live streams over on Telegram, because the way I understand the situation is, yeah, they do have a big credit crisis happening in China, and that can like stoke nationalistic fervor to go out and prove themselves, or even to change the minds of people away from the financial crisis towards the enemy abroad that's actually the one doing this to them. So I can see that. But they have the 20th party Congress coming up later this year, and Xi is up for the first prime minister, or leader of the Communist Party, first time ever that they'll get 3 terms. So he's breaking with tradition, and he's becoming emperor for life. This is a very important year for Xi Jinping. And so I don't think they would want to start a war or start something right before that happens. Also, zero COVID. Zero COVID proves that they value loyalty over the economy. They're willing to crush their economy just to prove that this city's loyal, or this minister or this province is loyal to Xi Jinping. So I don't think that they care too much about the economy. And yeah, so that's my initial thoughts. Plus, they aren't militarily strong enough to take Taiwan. I don't think they have. I mean, it's completely different than Hong Kong. So Hong Kong, they have bridges, it's right there on the coast. But Taiwan, it's an amphibious landing, and that is the hardest thing to do in warfare against the world's largest navy, the United States Navy, and hardcore dug-in defenses of Taiwan. So it's not an easy thing to do, and they risk failing right before the 20th Party Congress. So I don't think they're going to risk that. I was like, no, this is the U.S. is calling their bluff. I wouldn't have done it, but a lot of people think like the U.S. is dumb with foreign policy, and I think 99% of what they do is dumb with foreign policy. But in this case, after looking at it, I was like, wow, this was actually a very smart move to call China's bluff. And the reason why I like this is because China they're globalists. They're in the same boat as the globalists over there in Davos, because China relies on the global system. They are the biggest manufacturer, the biggest importer and exporter of almost everything out there. They rely on international trade. And so they are globalists. They want globalization. They did so well in the last 20 years, 30 years based off globalization. So that's who, in my mind, who I would fight against the globalists, and China fits right into there. Plus, of course, there are human rights abuses and all of that stuff going on. But yeah, that's my thoughts. Any pushback on that, Christian?
No, I mean, I largely agree, and I did hear kind of analysis talking about this Congress, and we've been talking about Xi becoming the emperor of China,
Yeah.
and how important it is. And really, it's kind of insane seeing, it all coming crashing down on the verge of him being crowned emperor. It's like, Rome is falling to some degree. But yeah, I mean, you've talked about this multiple times on the show. Deglobalization, reduction in credit, and reduction in growth is really, really, really bad for China, because everything about China is kind of or modern China has been built on this most recent, kind of globalization trend.
Oh, absolutely. This morning I had a rant on my Telegram live stream where I went through, why that over the last 75 years since World War II, why have we moved away from a commodity money towards a pure credit-based money? And mainly it's because, the strength of pure credit-based money is it's an expansion capability, right? You can really lever up with the credit-based money. And so after World War II, they had just a world that was ready to take on credit. So first they expanded credit in Europe, and Europe had a recovery. Then they expanded credit in Japan, and Japan had a recovery. Then it moved over to China, and they just kept expanding credit. But credit-based money has a weakness, and that is once it expands too much and it has to deflate, then everything will go. So I think that it was a natural evolution towards credit-based money after World War II. We can see this in the evolution of the Eurodollar system. No one planned the Eurodollar system. It just naturally evolved to take over in the 60s and 70s. And then you have the end of the credit-based system and a return to a commodity-backed money, which is Bitcoin, because the strength of a commodity-backed money is that it controls credit, right? It keeps bubbles from getting out of hand. Well, what do we have now? We have the biggest credit bubble the world has ever seen. So naturally, I think over the next decade, the world is naturally going to go towards commodity-backed money again, which Bitcoin is the best choice for that. So this is a natural evolution towards credit-based money and a natural evolution away from credit-based money towards Bitcoin. All right, I'll get done with that. What are your thoughts on that rant there, Christian?
Great rant, great rant. And I agree that there is this monetary sea change. It is absolutely incredible to see a world where, you saw Iraq get invaded, you saw
Yeah.
Gaddafi getting assassinated, when they ever tried to question dollar supremacy and the dollar monopoly on oil sales. And now we see that system have been completely and totally disrespected. No one cares about it anymore. Yes, there are
Mm.
no other liquid alternatives, but no one is scared of that system anymore. And I think it's fair to say that the petrodollar may be over. So, with that kind of context, you know, what is going to fill the void as all of these, the BRIC nations are starting to scramble and get more allies, and people are trying to find some sort of alternative system, and they're trading like the worst fiat on the planet. So I think that is ripe for Bitcoin to fill that void. I think Bitcoin is that neutral settlement layer. I think that proof of work makes Bitcoin very palatable for countries. And I agree that Bitcoin as a commodity money is perfectly placed in this time of transition.
Yeah, well put. I think that everyone knows that the dollar system is fatally flawed, especially everybody in macro, everyone in like investing, large money moves of governments and large multi-trillion-dollar corporations. They all know that the dollar system is fatally flawed. It's just the least fatally flawed right now, right? It's the least bad place to be in the coming crisis. And so that's why that's like the dollar milkshake theory, that it's going to suck value out of the other currencies and into the dollar. But the end, like I think a lot of people think that the end will be inflation. And that's one thing we've talked about for a long time, is that people think that the government will just print more money and the end of the credit bubble can be fixed by more debt. We'll actually get inflation. But really, the end of it is a deflationary grind. And like I said, at the end of a credit-based system, it's going to be a natural evolution towards a commodity-backed money because it plays to the strengths of the commodity-backed money. So anyway, that's all I got for this week, man. What else should we wrap on here?
Where's Bitcoin going from here, Ansel? I know we talked about the chart, but are we going up? Are we going down? Is Bitcoin affected by this crazy uncertainty that all the hedging that we're seeing in the bond market? What happens there? Like, let's try to like bring it back to Bitcoin a little bit and maybe give people some insights onto at least what you're thinking about the short-term effects.
Yeah. So it was a surprise with the FOMC that after they raised interest rates by 75 basis points, which is supposed to be tightening and it's supposed to be bad, right? It's supposed to be bad for the market. At least it's taking stimulus away from the market. Stocks and Bitcoin rallied. Now, why would that be? Well, at least for stocks, we know. Sorry, my chair keeps clicking. I have an old chair, an old car. I'm a real Bitcoin hodler. But anyways,
hey, you're short Bitcoin if your chairs and your cars aren't older than Bitcoin. That's a fact.
Okay, so the stocks rallied because stocks are forward looking, and maybe they see some credit crisis in the near future. But if you look back at September of 2019, they also saw something happening in September of 2019. I mean, the Fed was pivoting and the Fed was cutting, but then we had a repo rumble. The market didn't care. The market looked at it and they were looking ahead of that. So I think that what stocks are doing right now is they're actually looking past all of this acute crisis that's about to happen. They're looking 3-6 months down the road past where this acute crisis is going. And so that's where I see the Bitcoin is going to go with stocks higher over the next 6 months.
Ansel, I remember when you were talking to Tom Luonga, who is a friend and someone who's been on the show multiple times. He was arguing that the Fed was just going to take it to the bloody end, and they were just going to rip rates up and bring Europe to its knees. Your position was a little bit more like, no, this is unsustainable. They're going to have to pivot, and even like the Fed tightening less than the expectations of them is showing some sort of a pivot-esque reaction from the market. What do you think of that dialogue from a few months ago, and how do you feel about, at least, it seems as though you were a little bit more directionally correct this time?
Yeah, well, I mean, I guess you could say directionally correct, but I didn't think rates would get as high as they did. and I thought they would fall faster than they have. But the disagreement I have with Tom, which love the guy, he's very passionate and fun to talk to and fun to read his articles. So if you guys haven't done it, go to Gold, Goats, and Guns. Just search that in Google and you'll find his blog. I mean, his writing is top notch. But anyways, where I don't believe that the Fed matters, right? If you would do better knowing what's going to come or predicting the future if you just forgot that the Fed existed. And then when you look at the rates, that the rates are telling you everything you need to know. The Fed, if they hike to 4, 5, 6% for the Fed funds rate, and the 10-year is down at 2%, the mythology of the Fed is busted. No one will believe that the Fed can do anything. Their whole forward guidance, their whole reason for existence will be gone. So I don't think as the 10-year and as the long bonds come down, the Fed must pivot because else they would lose confidence. Another thing also is look at the repo rumble. Okay, the repo rumble was a highly acute problem with the repo market where it went bidless. You could not borrow cash and you could not borrow treasuries in the repo market. It froze. And when that happens, the system is about to explode. And the Fed had to react. They had to come in and provide stimulus to the market in that case, because if they didn't, the whole market would just unravel. Now, the Fed can't say, oh, look, I'm going to do this specific mechanical injection of stimulus, but they can come in and say, don't worry, guys, don't panic. We got you. It's going to be okay. We'll do this thing that will give some liquidity to the market, and then people will stop their panic and they will get back into the swing of things. Because what happens in those panic times, is somebody's trying to borrow money and they can't find any money. And so they continue, they keep raising their bid. And the rest of the market's looking at, oh my God, this guy's about to explode. So they're not going to lend to anybody because there's a contagion everywhere in the market. And so the people are panicked and liquidity just goes to zero. The Fed can handle that because they come in as the God Almighty of the market and they say, look, guys, don't panic. We got you. We're going to get this back on track. And then they get past that acute panic phase. So anyways, long story short, I think that's where we're going towards. Again, we're going towards an acute panic phase, but stocks and Bitcoin are looking past that. They're looking forward 6 months down the road instead of 2 months. So that's it. I hope that made sense.
No, it makes sense, and I've also just been, while listening to you, looking through the comments here. There's a comment that they should call you Ransel instead of Ansel, because you go on these spirited rants. And someone also is commenting that $5 per sat is a bear case. I love that. I've successfully turned myself into a Bitcoin bull meme with my ridiculous dollar per sat, $5 per sat, $6 per sat. Let's just call it predictions. But I do believe that $5 per sat is probably a bear case, and Bitcoin hyper Bitcoinization is infinity divided by 21 million. And because Bitcoin is better money, it's going to make the infinity bigger too, because it's actually going to make our economy more productive, because we don't have to go through the economic hurricane and shit show that we're currently, being subjected to. So end of CK rant, I guess. But a big point of the show is to just show how bad, the current system is.
Well, wait, what about if they peg $1 to 100 sats? Then it can never get to 6 sats.
Yeah, that's how the central banks stop hyper Bitcoinization. It's just peg their fiat to an obscene amount of sats.
I mean, back the dollar with Bitcoin at 100 sats per dollar, and that would be 1 sat per cent. That's a possibility in my future. So whatever, my predictions.
All
And
right,
so
Q.
you're becoming so bearish. I love it. I tease.
Yes.
I just came on because I figured
you're
I'd tell you
muted.
guys. Oh, am I muted? Wait, can you actually hear me?
You're struggling,
delayed.
bro. Now we can.
You're speaking to us from
Delayed.
the past.
All right, see you, Q. Y'all, you can follow me at CK_snarks. Q tried to sabotage my Twitter follows, but don't listen to him. Follow me at CK_snarks. Number continues to go up on the follow, so I appreciate you all. And make sure to get Bitcoin Magazine print censorship resistant issue. Make sure to subscribe for the collector's issue where you get 2 copies, 1 plastic wrapped. Make sure to go and get a copy of the newest issue that's coming out next month. It'll be part of the subscription. And don't forget about Bitcoin Amsterdam. That is coming up in very close to 70 days here. So Bitcoin Amsterdam is going to be a blast. If you're at Bitcoin 2019, nothing better than a bear market Bitcoin conference. It's going to be a lot smaller. It's going to be a lot more diehard. Can't wait for it. October 12th to the 14th. Ansel.
All right. So people can follow me on Twitter at ansel lindner and check out bitcoinandmarkets.com. That's where most of my content gets correlated there. So go to bitcoinandmarkets.com. Thank you.
All right. Back to the hosts.
Are we dropping it off to P or Q? Oh, Q's back.
Am I back though? Can you hear me?
Yes.
Okay, cool. We're going to do a hard wrap here. So tune in tomorrow. We're going to be joined by Jeff Ross. Buy the censorship resistant issue. Use promo code BMLive if you go to the Bitcoin Magazine store for that and anything else you want. And also your Bitcoin Amsterdam tickets. Do it for the kids. Buy that Bitcoin Amsterdam ticket. I'm the kids. Do it for us. All right, guys. Have a good rest of your day.
See ya.
Let's go.